Hello, everyone. Welcome to our webinar today with Chris. We're going to be talking about all things taxes, financial planning for the new year. We have a lot of stuff going on. I see people starting to roll in. It's always hard at the very beginning because it's like, how many people are in here? Everyone's rolling in at the same time. But as you're joining in, we would love to know a little bit more about you. So down at the bottom of your Zoom bar, there is a chat button. If you go into that chat button, open that up and make sure it's on everyone. Drop your name, your company, where you're from. And then we have a little game that we kind of want to play, or Chris had this idea, and I think it's really interesting. We're going to play Do You Know Your Numbers? So when you're dropping in the chat, say your name, your company, where you're from, and then if you know your gross, what was it again? Gross.
We want to know your gross profit percentage, otherwise known as your gross margin. Some people are
Gross
sensitive
margin.
about sharing that. So, no pressure.
No pressure. Just say, like, do you feel that you're confident in knowing your numbers? And if you do know that number, go ahead and feel free to share it. So as we're waiting, we'll probably get started in a couple minutes, but go ahead, drop your information in there. And if you're willing to play the Do You Know Your Numbers game. Ooh, Charleston, South Carolina. I bet it's a lot warmer than what we're experiencing here in Nebraska.
What is it in Nebraska? It's only so we have employees in a few places. We have 2 employees in far northern Minnesota, where this morning we were on a call and it was negative 35 degrees Fahrenheit, real temperature. And
Wow.
here's the great thing about it. One of our employees who's phenomenal, Lauren, she's amazing. Her heat went out.
Oh,
So she's sitting there, just crossing her fingers that the house doesn't freeze.
yeah, putting her like hat and her gloves on inside with
Yeah,
a
she
big
did. I
coat.
could see her breath during our call.
Wow. Nope. I mean, it got down to like negative 20, what feels like negative 20 or so yesterday. Same thing today. It's not fun for us. So, ooh, we have some people sharing their numbers in there. I don't know if you have the chat open, Chris, but we have some people sharing their numbers in there.
All right, let's see. Let's
Yeah.
see if we have pretenders in here or people who actually know what's
Yeah.
happening.
And I will say to anybody that is just joining, welcome to our webinar today. We'll get started in a couple minutes, but please in the chat at the bottom of the screen, add in your information, like who you are, where you're from, what's your company. And then if you are willing to play our game, it's do you know your numbers? It's do you know your gross margin percentage? And if you would like to share that, feel free to, but we're going to kind of dive into some of those things today.
This is great. I'm seeing some real numbers. Usually when I ask this question, almost universally, we see numbers that don't make sense. And it's either because people want to puff their chests up a little bit. No, I'm a great builder. Look at how good my numbers are. Or they just don't really understand it. Or they're confusing their margin with their markup.
Oh, yeah,
Those numbers are related, but they're not the same thing.
they're not the same for sure. All right. We'll go ahead and at least start kind of introductions right now, and kind of setting some ground rules as a few more people roll into our webinar today. But I'm really excited this. It's a very timely topic, I think, for everybody in the industry right now, tax season. But what's really great about this webinar is we're not just talking about taxes and just, there's this magic pill that's going to help solve all things taxes. It's really going to be about being strategic with how we look at our, accounting software, how we look and use the information coming in to really prepare for tax season, but then also planning for the future. So we're really excited to kind of dive into that today. But just to set a couple ground rules as we get into here, Chris is going to be interactive with us. And so we would really like to hear from you. So at the bottom of the screen, you're going to see the chat, which you guys are probably already using. The chat, please feel free to keep commenting in there. We do have some moderators behind the screen from Buildertrend that are more than happy to interact with you, especially if you have any questions around Buildertrend. But if you do have a direct question from Chris or to Chris, at the bottom of the screen, there's also a QA feature. That QA feature, if you have a question for Chris, please drop it directly in there. So that way we can get to it at the end of the webinar. That way we don't miss anything. And then if you guys really are identifying with something or like something that Chris is saying, at the bottom, there's also a react area where you can like something Chris says. Maybe he'll ask you to raise a hand if you want to participate, throw up your hand there. But ultimately, we want to make this a great experience for you guys and then, interacting with your counterparts as well. Did I miss anything, Chris, to get us started?
I don't think so, but your intro reminded me of
Oh,
one of my very first days on on the job, fresh
yeah.
out of college. I was listening. It was kind of a virtual environment. It was at Intel, and I was listening to a call as somebody who didn't know anything, and somebody forgot to mute their microphone.
Oh,
And one of the smartest people I've ever heard speak was speaking. And this person was a new analyst like me, and they said, this effing lady doesn't know what the F they're talking about. And then she
oh
said,
no.
by the way, she's like some very smart senior person at one of the biggest companies in the world at the time. And
Yeah.
she just very, very coolly said, whoever thinks I don't know what the F I'm talking about, please you might want to mute your microphone.
Oh,
So to Kate's point, if there's
yes.
something you don't like about what I'm saying, put it in the chat. Let's talk about it. I'd love to hear
We'll
about
talk
it.
about it. Yeah.
Yeah, I'd love to hear about it.
Yeah. And again, this is what this space is for. It's for us to be able to collaborate and then learn from industry experts and share. Maybe people are doing things differently. That's okay. But we wanted to bring in one of our great partners, Monthend. Chris here today. He is the founder. And I'll let him kind of share a little bit about his background and his work in the industry. And then I know he has a really full set agenda for us today, but I'm gonna let Chris go ahead and introduce himself right now.
Thanks for having me. I've been
Yeah.
working with Buildertrend directly or indirectly since Buildertrend started almost. 2010 is when I started using Buildertrend as a builder. And let me get into my slides here and I can give you a little bit of understanding of what that looks like. So that right there, 2008, I started developing land, and 2009, 10, we said we need a better way to build houses. And spreadsheets is not a good way to do it. So we found Buildertrend. So we've been using Buildertrend since 2010, and I was partner and CFO of that home building company for 10 years. And then I said, I don't really know enough about accounting to be a CFO. Even though I did it for 10 years, I have a finance degree. I've been running an accounting department. I feel like I'm undereducated. So I went back, got a better education. And then at the bottom here, we see Monthend started in 2018. And what do? We optimize Buildertrend and QuickBooks. We do daily, weekly, monthly bookkeeping inside of QuickBooks and Buildertrend. We close your books and we have a management discussion and analysis every month with your controller. And then you do it over again. And the idea is get perfect information so you can make good decisions and continue to get better at operating the financial tools inside of QuickBooks and Buildertrend. So just showing you this to show that I was a builder. I have experience in home building. We have a lot of accounting experience, both me and in my team, and we see a lot of things. So it's really exciting to be a part of this space because we can have a big impact on people, and it's a lot of fun.
Love it. Well, and we're so lucky to have you as partner and, just the future of, how our products developing, our partnership together and just like, Buildertrend can't do it all, but we need to have the best partners and our best partners can do it all. So, um, yeah, and I think it's really exciting. I'm really excited to dive into taxes today, which I know it's really not just about taxes because we got to talk before. It's not just about taxes. It's really about really thinking holistically about your financial planning and how you really are organizing your financials. So I'll let you go ahead and outline that agenda for us today and turn it over to you.
I'm glad you bring it up that it's not just about taxes. So when I talk to my team and we have a client who we're not getting a lot of, we're trying to engage, they're not engaging, I say, all right, what people want to know about is how this affects their cash. How does it affect their pocketbook? So tell them that what they're doing and draw a connect line, a direct line. Tell them that what they're doing, here's how it affects you. Here's how much it's costing you by not giving us this information. So I'm glad you brought that up point. And so the first thing I want to talk about is why do you care about taxes? Why do you care about forecasting? Why do you care about getting your year-end 2024 correct? How does it impact you? Right. And here's a little sneak preview. It's not just about tax savings. How can you save cash at tax time? A lot of you are on this call because that's what you came here for. Tell me how to save money. And we'll talk about that. Spoiler alert, there's no magic bullet. There's no magic tax loophole. There are some great tax things you can do. Most of those things are on the personal income tax side. The business side, it's about fundamentals. For the football fans out there, good football season right now, we're going to be talking about the blocking and tackling. Without that, nobody's scoring any touchdowns. How do you create a forecast? So we're talking about what happened in the past. When people think about accounting, it's what happened in the past. When you think about finance and when you think about planning and you think about driving the football down the field, it's about creating a forecast and then trying to stick to it. Sometimes I'll call a forecast a target. It's probably a better term for it. We're really setting goals and we're setting targets. Well, how do you do that? It seems simple, but it's not that simple. And for those of you who need somewhere to start, we're gonna end up with somewhere to start. So, and then how do you use that forecast to actually make a meaningful difference? So you can predict the future all you want, but if you can't use that prediction in a meaningful way to change what's happening in your business, it's kind of an exercise that's a waste of time. And then finally, we're going to do a live demonstration. So this isn't just a webinar where we're sitting here learning. We're going to show you things. We're going to show you how to take a lot of this stuff into your own hands. Right? So how do you hold your accounting team accountable? How do you create a plan that makes sense? And so we're going to give you a list of to-dos at the end of this that you can take from this webinar and actually put into practice.
I love that.
All
Well,
right.
excited to get started.
Should we fire it up?
Let's go.
Kate's ready. Andrea, Urban Edge Homes, Edina. Do you recognize where I'm sitting here, Andrea? I'm sitting in your town. Our team is across the country. We just happen to be a couple of us here in Minneapolis because that's where I got started. So nice to see you, Andrea.
Love that.
Why do you care about year-end and forecasting? All right, let's start. Why do you care about year-end? When I talk about year-end, what I'm really talking about is why do you care that your books are accurate, especially at the end of the year? Why do you care? Why does it matter that your accounting is accurate? Why does it matter? All right, let's talk about it. First of all, right now, for most of you, I would say 90% of you, and this might be a shock to you, your numbers are not giving you information you need to drive profit decisions. Put another way, your books are bad. I talk to people every day. Yesterday, I talked to 5 builders and I looked at their books, 5 books. If we take all of the books we've looked at, I've looked at 942 sets of books since I started this business. And less than 10% of the books we see are decision worthy. And what I mean by that is your books do a lot of things. There's 2 things: compliance, make sure your taxes are right. Okay, that's great. More importantly, your books are supposed to be a weapon. They're supposed to be a dashboard to be able to give you information to make decisions about your business to help you make more money or not lose as much money. And for most of you, and in our experience, about 90% of you, you can't use your books that way. For you, it's just compliance. You're just doing it because you're supposed to, because you have to file taxes. It's the wrong way to look at it. Your books can be a real weapon, and that's in any business, but especially in construction. So out of the 942 books we've seen, or 952 books I've seen about 100 of them that can actually be useful for making decisions, maybe less than that, probably less than that, actually. So that's why you care about year end, because you want your books to make sense, and you shore all of that up at year end. You want to be able to make decisions. Why else do you care? That's a big point, by the way. Right? Let's talk about what kind of decisions you can make with that. Let's get into that just a little bit. I asked everybody what their gross profit numbers are, and there's a surprising amount of honesty here. 7.2%, 18%, 19%. That's actually the numbers that we are seeing in reality. Usually when I ask this question, people say 30%, 40%. Those aren't real numbers. People don't make 40% gross margins in this business. The market won't allow it. If you're pricing to the point where your gross margins are 40%, whoever's buying that from you probably isn't going to buy it from you. They're going to find somebody else to buy it cheaper. So the market doesn't really allow you to get 40% margins. Sure, in certain cases, if you have some sort of competitive advantage, you might be able to get there on occasion. But generally, the numbers that I saw on here are real. People talked about 19, 18%. Those are real numbers. Now, you can do better, right? But the first step is knowing what your numbers are, knowing what the benchmarks are. If we're talking about a benchmark, a good goal for people starting out is 20%. If you're doing that, usually you can make enough money to support your family. Right? If you have a big business, 20% is going to usually provide you a lot more than just supporting your family. If you're just a one-person show and you're getting 20%, again, that's fine. Most of you are in this middle area. You're not a one-person show and you're not this big company. So understanding your numbers gives you the ability to do things like ask questions like, am I pricing my jobs enough? Is my price okay? Or Are my costs out of control? Or for the amount of overhead that I have, do I have enough volume? Am I selling enough? Or answer a question like this. Can I afford to hire somebody? We're growing and I need to hire a project manager. Can I afford it? So good books give you those answers right away. Most of you don't have the ability to do that. Second reason to care about year end. This is maybe why you're on this call. How do I save money on taxes? You're overpaying your taxes. Almost all of you. In fact, 60% of people we see have tax returns that are materially wrong. And most of those 60%, they're overpaying. And we'll get into a little bit about why that is. But generally, it's this. The IRS is not holding your tax preparer accountable, right? That's called an audit. An audit is holding your tax preparer accountable. That happens in 1 out of 100 or 1 out of 1,000 tax returns. There's nobody holding them accountable. And usually they're holding your tax preparer accountable for underpaying. You don't care. You don't care about that, right? So nobody's holding your tax preparer accountable. Your bookkeeper or your accounting team is probably not holding your tax preparer accountable unless you have, an all-star construction specific, experienced, educated accounting team, which some of you have, most of you don't. It's hard. You can't afford it. So nobody's holding your tax preparer accountable. Who's holding your accounting team accountable? It's not your tax preparer. Some of you might think that's the case. Tax preparer gets the books. They're going to hold the accounting team accountable. Rarely is that the case. A tax preparer is a generalist, usually not construction specific because they can't feed their families with one industry generally. And the tax preparer doesn't have time to hold your accounting team accountable, right? They have to do 100, 200, 500, 1,000 tax returns in a couple months. They don't have time to go fix the books, make sure they're right. So who's accountable? Anybody want to guess? Who's the one who has to hold the accounting team accountable in the comments? I think it's pretty obvious. It's you. How do you do that? Any CPAs on this call? Probably not that many. Not if you're also running a home building company. It's rare. Who's going to do it? It's you. Do you know how to do it? No. You're going to leave this call today with a general understanding of how to spot ugly. Right? If I walk through a house that's newly been framed, if it's starting to tilt to the side and I think it's going to fall over, I can spot that as bad framing. You as a building professional, even though I've been building, I was on the finance side, right? You as a building professional, you can spot good from bad really well. All right. But with your accounting, you can't. I'll at least give you the tools to see if the house is about to fall over. All right. And we're going to do that throughout this presentation. And we're going to do it at the end of the call too. We're going to dive into QuickBooks. I'm going to show you where to look so you can hold your accounting team accountable to make sure that they're doing the right thing. How are we doing, Kate?
Doing
All
good.
right.
Do you have some individuals from Canada here? So just letting you know if some of that might impact them a little bit differently as they speak, or if something does maybe relate. I believe it's just there's different taxes and obviously different rules and everything, but I think the
Yep.
stuff you're sharing will definitely be good tactics on how to make sure your books are correct. So
100% of what we talk about today is just applicable to Canada as it is to the US.
Yep.
We're not getting into tax strategies and loopholes. That's all done on the individual side, right? Canada, you have a little more going on with GST and value added tax. Nothing we talk about is applicable to any of that. This is information that can be used anywhere in the world. I know we have a lot of Aussie and New Zealanders that are big Buildertrend users too. So this is just as useful for you.
Definitely. I think, and I'm really excited about how you transition this into like full financial planning and not just the tax, like you said, the little things about taxes that get under our skin. Yep.
Yeah, and it's all related. What happened in the past and what's about to happen in the future, there's a point where those come together, and that's today. Today is the day.
Mhm.
All right, care about forecasting. Why do we care about forecasting? This is nice. A goal without a plan is just a wish. So there's a study that was done a few years ago with 300 participants at a university in California. And they took these participants and they had people that set goals just in their brain. And they had people that set goals, wrote it down on paper and told people about it. And that group of people was 42% more likely to hit their goals just by documenting them. All right. Super, super powerful. So part of the reason we care about forecasting is just hold yourself accountable, document it. The second part is you can't really adjust course if you don't have a route. If I'm going out for a ride on my bicycle and I'm trying to get from point A to point B, but I never really defined what point B is, I'm never lost, right? Because I'm not trying to get anywhere. So we care about forecasting because we want to create a plan. We want to create a route or a route, depending on what country, part of the country you're in. And we want to measure your actual performance against your targets to know if you need to make a change. Google Maps does a great job of this, and it does it automatically for us. Take a right turn before we're supposed to, it tells you to do a U-turn. Isn't that the most annoying thing ever? I don't know if you guys are like me. I get so mad at myself for messing that up. And anyways, it's all about being efficient, taking the most direct route possible. Planning and forecasting lets you do that. Right? Drum roll. This is what people really came here for, and you might be disappointed in the answer. How can you save cash at tax time? Here's the answer. Your most powerful business tax strategy isn't some crazy loophole, right? It's not something that some hedge fund carried interest exemption, right? For your personal taxes, there's lots of things you can do. We're not going to talk about that today. It's complicated. It's nuanced. It changes every single day. What can you do for your business, though? The most powerful tax strategy for your business is accurate accounting. And we'll talk about what that means and why that's true. First of all, capturing all of your costs. People generally do an okay job of this, but very few people are getting it all, right? So if you're not capturing all of your costs, you're not getting all of your deductions. If you're not getting all of your deductions, your income is showing as higher than it is. Two problems with that. One, you're going to pay more taxes than you should. And two, you're doing better than you think you're doing better than you actually are. So you're not making course corrections. You're not adjusting your route, right? So first of all, make 101% sure you've captured all of your costs. Here's how you do that. One, every single account, bank account, credit card account, financial account that you use inside of your business, make sure you're doing two-way reconciliations. What does that actually mean? You spend a bunch of money in your bank. We need all of those transactions to show up in your books. Furthermore, we need them to show up in the right spot. That's a challenge too. That's one way reconcile. The other way to do the reconciliation is you have a bunch of stuff that shows up in your books. You have to make sure that actually happened inside of the bank. A lot of accountants, a lot of bookkeepers, a lot of finance teams, they do the first part really well. It happened in the bank. Yep, it's in the books, but they don't do the second part well. It's a mess. All right. So one of the most powerful things you can do is to make sure you've captured all of your costs. Every dollar, if you're paying 30% in taxes, federal taxes, or if you're in Minnesota, it's 30 plus 10, and it goes even higher than that, right? It goes up to 37.5 plus 10. 47, half of your money in just income tax is gone. For every dollar that you're not properly capturing, that's 50 cents in taxes that you're paying. $100, $50. 100 grand, 50 grand. So let's make sure we capture all of those costs, right? Quit looking for loopholes. This is where it's at. Second, and this is a way bigger lever than that first one, is your revenue and cost recognition accurate? This gets really technical, all right? There's certain rules that the IRS has, and there's certain rules that the accounting bodies have that dictate how you have to recognize your profits, right? It's very complicated. It's very nuanced, and you have to track it just right. So you see the little green thing, it's a little screwdriver. It's the tool to make sure this is happening correctly. So make sure you've captured all your costs. There's a lot of tools, but the biggest tool is that two-way reconciliation. Is your revenue and cost recognition accurate? Let me talk a little bit more about what this is before we talk about the tools. And I'll give you a pretty good example. Most of you are on an accounting method called percentage of completion. All that means is as the job progresses, you recognize profit on it. If the job's half done, you should recognize half the profit. Let's go to the end of the year. December 31st, you sign a contract. Client gives you $100,000. Awesome. You got a job, a big fat job to start next year. What is that $100,000 in your financial statements? Is that profit? That income? What is it? Well, it's not profit and it's not income. Most of you are booking it that way though, right? What are you doing then? You're paying taxes on that $100,000. You haven't spent a dollar against it. You haven't done any work. It's not your money. You shouldn't have to pay taxes on it. So how do you handle that 100 grand? Well, the process of handling it and the rules that you apply to it, that's called revenue recognition. So what I'm talking about in this bullet point is your revenue and cost recognition accurate? There's no easy answer. We can tell you if it's wrong, and I'll show you how to do that at the end of this call. But knowing if it's right, the tool there is probably an experienced person. They'll tell you if it's right. Your tax preparer, here, shocker, maybe you know this already, they probably don't know. because they're the person who set you up with bad stuff in the first place. All right. So 2 kinds of revenue recognition. Percent complete is you recognize it as it happens. The other kind of revenue recognition is you recognize profit when the job's done. Both of those have nuances. Both of them are complicated. And we're going to show you how to see if the house is falling over or not at the end of the call. That makes sense? Awesome.
So far, no questions. You're on a roll. You're doing great.
Yeah, I don't know if that's good or bad, but we do have time at the end for questions.
Yes, we do.
Here's another thing to look at to see if your books are right. Your AP, that's accounts payable. That means you get a bill from a framer, you put it into the system, and you haven't paid it yet. That's AP, that's accounts payable. AR, accounts receivable, that's you create an owner invoice, hopefully through Buildertrend. If you're not creating your owner invoices through Buildertrend, let's talk about it. You should be. You should have it connected to QuickBooks. Enter it once, let it flow through, let the machines do the work for you. So an owner invoice that is not yet paid, that's accounts receivable. Is that accurate? We see a lot of weird stuff happen, especially with Buildertrend. So let's talk about a really practical thing inside of Buildertrend. Let's say you create an owner invoice inside of Buildertrend. It sends it to QuickBooks. Now you delete that owner invoice in Buildertrend because you screwed something up and you recreate a new one. Well, now you have 2 owner invoices inside of QuickBooks. You didn't go back and delete the bad one. Well, that invoice shows as income. That income shows as profit. That profit is getting counted as profit on your tax return. Your bookkeeper might not know. Your tax preparer doesn't know or care. That's a lot of money out the door that shouldn't be. Does it happen a lot? More than you think. All right. So really powerful tools. Look at all of those things, and I'm going to show you how later. Are your payroll liabilities correct? This is a problem for almost everybody. There's 2 main financial statements. One of them tells you all about the health of your company. It's called the balance sheet. The other one tells you about the performance of your company. It's called the P&L, income statement, profit and loss. If you look at the health of the company section, you have a section that talks about payroll liabilities. Those are the payroll taxes that you owe, or maybe 401k payable, right? Health insurance payable. Those are always wrong. People screw that up relentlessly. So we're going to talk about what to look at there to see if the house is falling over, to see if they're wrong. Because a lot of times when they're wrong, you should be recognizing expenses that you're not. So you're reporting profit that's higher than it actually is, paying more taxes than you should. All right, so some of this is technical, but we're going to show it to you in such a way that it's not technical at all. You know, if you can identify the difference between blue and red, you should be able to spot this stuff, and then you can have a conversation with your accounting team about it. All right, how can you save cash at tax time? You do these things. If you leave this and you do these things, I guarantee you're going to find some stuff in there that's going to shock you, and hopefully it's going to be a tax savings. Sometimes it'll go the other direction. Oh, wow. All right, well, that's okay too. You saved yourself tax fraud or a tax audit issue. All right, we're shifting into forecasting. So we talked about the past so far. What happened? How do I know if the books were done right? We really talked about the past. Accounting is really about the past, putting things in the right spot. And now we're going to talk about, well, what do we do with that information when we have it? And how do we affect it? How do we change it? How do we weaponize accounting? How do we use accounting instead of just a cost center, something that I have to do, something that I have to pay for? And how do I get a huge ROI on it by using the numbers to make significant changes to my business? Well, there's 2 ways to do it. One, you can just use the actuals and try to make changes that way. Better yet is to create a plan. So you have something to measure against rather than just what happened last year. So how do we do it? How do we create a forecast? There's 2 ways to do it. There's a bottom-up forecast and a top-down. There's a hybrid approach, but let's talk first about bottom-up. So to create a bottom-up, first of all, what are we talking about when we're talking about a forecast? What we're trying to do is guess what's going to happen at the end of the year. So all a forecast is I'm going to try to guess what my numbers are going to be at the end of 2025. It's not just a guess, though. It's also setting a target. So you're not just guessing what they're going to be. You're going to dictate what they're going to be, and then you're going to manage your business to try to get to those numbers. All right, so there's a few ways to build this forecast. And what does a forecast look like? Well, it looks like your P&L. It looks like your profit and loss or your performance. So we have revenue, we have costs, we have overhead, and we have profit. That's what your forecast is going to look like. We're going to do it by month, and we're actually even going to break it down job by job. So how do we build it? How do we think about it? We have bottoms up. Bottoms up, we start with known numbers. Right? So we start with known numbers like what your fixed costs are, what your salaries are for your overhead team, your marketing team. Your historical gross margins are a good place to get an understanding of how to build your forecast. If you've historically hit 18%, like we've seen some people in here, 19.2%, if you're comfortable with that number and that's a number that makes sense for you, use that number as a starting point. I would prefer that you create a stretch target. If you're currently at 19.2%, build a forecast where you're forecasting gross profits of 23%. And then use the Buildertrend job cost budgets to build gross profits on each job that make it work that way. Well, in order to do that, you have to estimate it that way. All right. You can only get what the market's going to give you, but find a way to get more money for your projects. That's a different webinar. We'll talk about that too. Different time. Invite me back, Kate.
You are always welcome. And
Awesome.
you know that you are coming to several of our Buildertrend universities over the next couple months. So that is a treat for anyone that gets to hear you there in person too.
I'm really looking forward to that. The last time I was in the Buildertrend building was a few years ago, and there's so much energy there, even in non-BTU days. It's just a great place to be. It's an inspirational place to be. So I can't wait to be there. So start with known numbers and fill in the blanks. That's a bottom-up forecast. And we'll get into the tactics of how we do it later, but generally you're going to start with LY, last year's data, and then use that as sort of a starting place to build out what next year is going to look like. So the other way to do it, so let's talk about losing weight. Something that, I don't know if I need to lose weight, but I need to get fit. Let's talk about losing weight. If you're creating a bottoms up forecast of how you're going to lose weight, that's similar to saying, all right, here's how I'm going to do it. Here's how I'm going to lose weight. I'm going to work out an hour a day with a goal of burning 250 calories during that hour. And a bottoms up forecast, that's how you do it. And then you say, all right, if I'm going to burn an extra 250 calories at that workout, here's the calories I burn throughout the day. Here's how many calories that I can eat in order to still lose weight. And then you back into how much you can eat. That's a bottoms up forecast. A top down forecast, which is what most people are more familiar with, is saying, I want to lose 10 pounds. And then you say, in order to lose 10 pounds, here's the amount of calories I can eat, and here's the amount of exercise I'm going to have to do. You see how they're different? Neither one of them are the wrong way to do it. It all just depends on what data you have available to you and how comfortable you are building forecasts. And there's a hybrid approach too. So top down, you're going to do something like start with a net profit number or a stretch target. The way I like to do it is, or the way I like to express this to people is, I want to make, as a builder, as a company, bottom line, I want to make $200,000 this year. Start with that. If I want to make $200,000, what do the rest of the numbers look like? What does my overhead have to stay under? How many jobs do I need to sell and at what price? What is the cost maximum of each of those jobs to be able to get to that gross profit minus the overhead to get to my goal of $200,000 in net profit? Pretty awesome. You might want to do it both ways, right? It's a really good exercise. This takes a long time to do, right? It's not easy to do. It takes a long time to do. You have to be very comfortable with ambiguity. You have to be comfortable with guessing. And that's okay, right? You're going to get better over time. Your first plan, not going to be great, but you're going to change it after the first quarter. And you're going to make it better, and you're going to make it better. And after a couple quarters or a couple of years of doing this, you're going to be so darn good at forecasting. And here's why. There's two reasons why you're going to be good at forecasting. One, you're going to have practice. But two, it's a self-fulfilling prophecy. Going back to the 42% of people hit their goal, maybe that first year, if you do a really good job and you have a lot of discipline, you're going to hit your forecast perfectly. And you're going to pat yourself on the back and you say, wow, I didn't know that I was such a good forecaster. Maybe you're not. You're probably not, right? You're a really good manager, right? You set a plan and you managed to the plan and you hit your goal. Maybe you are a good forecaster and a bad manager. Maybe you're both. Well, let's start with creating that forecast. Let's create a plan.
I think that's important because a lot of, I think, our builders come to us like, whether it's around the core product or around, things outside of our core product, like services like you, it's about like, where do I start or how do I what is the magic answer to it? But it really is coming back to you just have to write it down. You have to put it on paper. You have to set a forecast, a plan for yourself.
Yeah.
So then you can hold yourself accountable or your team accountable or whatever. So I feel like that's that's huge around this forecasting. It's a lot bigger. Yeah.
So I'm just looking at the comments right now, and somebody brought up a question. Don't you mean net profit? So let's make a couple definitions. Let's go over a couple definitions of what we're talking about. I think that's very, very important. So revenue, that's what you're selling, right? If you're selling remodels, it's the contract price, right? Cost, that's how much it costs you in direct materials, direct subcontract labor, and then soft costs like permits, right? So when we take the revenue of a project and we subtract all of those costs, that's your gross profit. There's other things that can be thrown into gross profit. For instance, if you self-perform your own labor and you have a good system for allocating the cost to that job, shout out Buildertrend time clock, you can get a better understanding of what your gross profit per job is, right? So that's gross profit. We're talking about gross profit because it tells you how well you do at pricing and cost control on the jobs. It's one of the most important numbers in your business. Okay. Now we get into the thing, we call that the line, by the way. If you ever hear somebody say above or below the line, gross profit is the line. If something's above the line, it's costs attributable to the jobs. If something's below the line, it's overhead costs. So if you have half as many or twice as many jobs, the stuff below the line doesn't change that much. It changes a little bit, but it doesn't change that much. Some people call it fixed costs, right? So below the line, we have overhead or fixed costs. Overhead is a combination of not just fixed costs, but let's keep it simple. Below the line is overhead. We all know what overhead is. It's rent. It's the power that's powering these computers. It's a bunch of stuff, marketing, travel to go to Buildertrend University. Great place to go, by the way. So overhead costs. We express a lot of these things as a percentage of revenue just to normalize it so we can have good conversations about it. So when we're talking about gross profit at 20%, we're expressing that as a percentage of your revenue. So that means out of every $100 you sell, $20 of it is available because $80 of it is to pay for the vendors and the subcontractors and the permits. So now we have $20 available. That's gross profit. As a percentage, it's gross profit percentage. Now we have overhead. So, by the way, benchmarks, what we're seeing and what the National Association of Home Builders will tell you, by the way, they publish a study every 2 years called the Cost of Doing Business Study, where you can get really good benchmark data. Cost of Doing Business Study, benchmark data. It will let you know how you're doing. It even gets down to the specific geographic region and the kind of stuff you're building. Single family home builders with land, single family home builder without land, remodelers, right? So it gets down to the details. So it's a really good resource. It's kind of hard to use and read, but buy it. It's like $90, right? There's a lot of good stuff in there. Also, we have our own benchmark data because we've serviced 300 clients, so we have our own benchmark data, and it's pretty consistent with what we're seeing out of the NAHB. So let's talk about benchmarks. Cost of doing business study, gross profit. 20, you're doing okay. 25, you're doing amazing. 15, you're kind of getting down into the danger zone. That all depends, though, on your organization. If you're a one-person shop and you're getting 15, you don't have a lot of overhead probably, so you're probably doing fine. If you're a giant organization and you're at 15, you're in trouble. You're probably making negative net profit. All right, so let's talk about overhead as a percentage of sales. 10 or less percent, you're pretty lean generally. 14 or more percent, generally you're kind of fat. So there's a reason to be fat. You expect a lot of growth and you need to be able to support that with your team. But if that's not the case for you and you do the math and your number is 15, 16, 17%, you either need to grow or you need to shrink your team. And maybe it's not just your team. There's other expenses that contribute to overhead. Again, these are general numbers. It's going to be wildly different for everybody. So that brings you to net profit. 0% is kind of average. It's scary to say, right? On average, people aren't making any money. It's a competitive business. People don't know their numbers, so they mess up their pricing. Okay? You probably are competing with people like that in your market. How does Joe Schmo charge this amount for this work? Joe Schmo doesn't know their numbers, right? 5%, we're talking something about average. The best in the business are 10% plus. Net profit. Net profit is generally thought of as the profit that you have after everybody's paid. Now that's different from cash. A lot of people are confused about profit versus cash. That's different because after you have your net profit, you might have to pay things like vehicle loans, right? Depreciation is part of that number, right? So there's a lot of things that make cash different than profit. Think if you have a super expensive, I don't know, Cybertruck. I knew I would trigger some people there. Hopefully I can trigger some people with the Cybertruck. You have a Cybertruck and you have a loan on it and you're paying that loan. Most of that is interest. Some of that's interest, but most of it is principal. That has nothing to do with your profit except for the interest part of it. So you made this profit, you're paying these loans, you have no cash in the bank. That's why. Profit and cash are not the same thing. All right. So how do you create a forecast? We're going to get into the details. We're running a little tight on time, so we're going to have to go through this stuff pretty fast. How do you use, this is the really important thing here. So how do you use your forecast after you build it? Well, first of all, you have to measure everything. And you have to measure it the right way. You have to be really consistent. That's the most important thing. Even if you're wrong, be consistently wrong. Because then your plan's wrong, your actuals are wrong, but they're wrong in the same direction. So how do you do that? How do you track your company performance? Well, tracking your job performance is super easy. You have the best tool ever invented for it, Buildertrend, job cost budgets. If you're using the old budgets, don't use the new ones. They have a lot of really great tools that help you more accurately track your job budgets. Phenomenal. Use it. So track your performance against your budget. How do you do that right now? There's not a lot of great tools out there. There just aren't. We're using spreadsheets. It's a bummer. All right. Sneak preview, there might be some better tools coming in the next couple of years. We're building them. Create a budget versus actual column and track the variance. That's how you're going to know how well you did against your plan. All right, so that's measure, step one. Step two, manage. All right, this is important. Analyze the results every month and dig into the variances. So you see I have a brain and a hot dog because there's no emoji for guts. If you guys have a better emoji for guts, I thought I saw one that shows the intestines, but when you search intestines in the emoji, it doesn't come up with anything, so that would be better. But a hot dog, that's kind of a fun emoji to represent guts. And so here's why I talk about guts here. So analyze your results every month and dig into the variances, and then force changes. Forcing changes takes a little bit of logic, a little bit of creativity, and more often than not, it takes guts. So let me give you an example of what takes guts. Raising your prices. You think you're going to raise your price and no one's going to buy your stuff anymore. It takes guts to do it. Hard to do. Try it. Give it a shot. Next time you build your next proposal, after it's done, bump that price up a little bit. Either you're going to increase your markup or add something. If you're cost plus, add something in there that you've never added. Technology fee, right? You're doing all this great stuff to manage Buildertrend. You're giving the client this great Buildertrend experience by letting them see the portal. Charge them for it. Right? So that's one small thing, but it takes guts to make changes. Right? So the brains part of it is make sure you're making the right changes. Measure how that change might impact the actual numbers. Take a guess, and then make the change. So that's how you manage to the target. So step one, you made a target, and now you have to manage to the target. And to know you're not on target, you have to measure it, and then to make a change, you have to have guts and brains. So tactical course corrections. You got to look at your pricing. You have to look at your estimating. You have to look at how you're buying materials. Shout out CDUSA. For overhead, it's less important. But if you have extra bodies laying around, or maybe you don't have enough, maybe you're struggling and you look at your numbers and your overhead is 6% of sales and your gross profit's 24%. Well, guess what? You're being a little greedy. You have a little opportunity to hire some people to help you out. All right, so we got a forecast and then we have to manage to the forecast, and that's how you get great. So your to-dos. I'm going to cruise through these in reality. We have time for me to open up QuickBooks and show everybody this. I'll try to do it really fast. Okay, analyze your bank and credit card reconciliations, look for evidence of WIP adjustments, review your aging reports, review your balance sheet, review your P&L. Let's look at this really quick. Earlier in the webinar, I talked about how you can hold your accounting team accountable and how you can tell if your stick frame building is about to fall over. I'm going to give you the tools right now to analyze that. I'll try to do it really quickly. Kate, if you could give me a hand, I'm going to start with this one. And when I'm done with that, can you tell me what the next one on the list is so we can fly through these?
Yes, let me take a screenshot so we can keep going. Got it.
Analyze your bank and credit card reconciliations for ghost transactions. All this is, and you're looking at QuickBooks now. Reconciliations aren't that easy to do. So if you want to see if your reconciliations are correct, I'll just show you one account. There's a couple ways to get to the account. All right, one way you can get to the account is you can pull in this bank transactions in QuickBooks. If you're not using QuickBooks Online, do it. I mean, it's so much better now than it was 5 years ago. Go to this bank register. Under this filter, what I'd like you to do is go to reconcile status, no status. And on this to date, just fill in the last date that you think the book should have been closed and then click apply. Now I'm using some demo books here so you can see all of these transactions, right? If you see any transactions at all in here, if you use these steps, and this is recorded, right? So you guys can come back and look at this and do these things. If you see any transactions in at all, after you do these steps, most likely your books are wrong. Your reconciliation is wrong. Right? Easy thing to do to at least start a conversation with your accounting team. In this case, like if this was real, you see tons of stuff in here that just shouldn't be. I'm not going to get into why it's that way. We don't have time right now, but just go do this. If there's transactions in here, make your accounting finance team explain them. Usually it's stuff that's old that shouldn't be in here. If it's a payment, that kind of works in your favor, but you still want to get it right. If it's a deposit, you're paying taxes on it probably. All right, next thing.
All right, look for evidence for work in progress adjustments or completed contract.
We're a good team, Kate.
Yeah, we got this.
So how do you do that? We're talking about your profit and loss report is the first place to really look. All right, so go to reports, go to profit and loss. Oh, come on, there we go. Profit and loss. Under the period, go this year to last month or last year, whatever. Pick a period that makes sense. You want this to be on an accrual basis. This sandbox books, I'm just going to have to do last year. All right, here's where you find this information. In this income section up here, you should see a row. This is if you're on percentage of completion accounting, which 70% of you are. If you don't see anything here adjusting out the deposits that you got from your customers and you're not using a specific deposit liability account, the books are probably wrong, probably overpaid on taxes. Now, a lot of people are going to say, Chris, you're getting crazy. We don't do that because we're on cash basis accounting. Why are you on cash basis accounting? You shouldn't be, right? Do you get your money and then spend it? Yes, almost every construction company does. You're killing yourself if you're on cash basis accounting. You shouldn't be. Don't change. All right, you got bad advice. If you're on cash basis accounting and you're not like a handyman or a handy person and that's your business, you just go fix small things, takes one day to do it, it's wrong. Change it. All right. If you're doing big projects that take more than 2 weeks or 2 months or 2 years, you cannot be on cash basis accounting. You're messing with your life. All right. I'm done preaching. So in this income section, you want to see a negative number here, most likely. Sometimes it's positive, but what it's going to say, it's going to say work in progress adjustment, WIP adjustment, customer deposit adjustment, something like that. That's an adjustment to the actual income. If you don't see that, you have some questions. You have some questions for your finance team. All right, next thing.
I would say we don't have any questions currently in the queue, so I think we're doing good on time. We'll use another like 5-10 minutes or so.
Awesome.
But review your accounts payable and receivable aging, anything missing, anything redundant.
Simple. Go into reports here, look for your payables aging. You can also use this little search, payable aging summary. Review these things. These are bills that you owe, right? If you see things on here that you don't owe, there's weird stuff going on. Now, worse actually is things that you know you owe that aren't on here. All right, hold your accounting team accountable. Why aren't they on there? We need to have them on there. They should be on here. They affect our financials. They might say, well, we just pay them as we get them and we report them once we pay them. Not good. Your metrics are goofy. Your revenue is going to be goofy, right? Because you make a revenue adjustment as part of the WIP adjustment. No, we need to get them in there. If you get a bill, get it in the system. Receivables is the same thing, but it's on the other side. It's revenue. Here's another way you can find reports, by the way. You just go to that magnifying glass. You can type in receivables and you can look for the report down here. So receivables aging summary, view more. AR aging summary. Aging just means how old is it? Same thing here. If you see numbers in here of you know that John Melton doesn't owe you money, but it shows that he owes you money, you're probably reporting that as income somewhere and overpaying in your taxes. Not good. So not only are you overpaying your taxes, but you're doing better. You think you're doing better than you actually are. So you're not making course corrections. Okay, that's receivables aging. If you see stuff in here that looks goofy, somebody doesn't actually owe you the money, something's wrong with your books. Happens a lot with Buildertrend because those who do a good job with owner invoices, you're pushing them in here. You got to make sure these stay clean when you make adjustments to Buildertrend. Next one.
Review your P&L by, oh, excuse me, review your balance sheet. Any negative numbers, payroll liabilities.
Yeah, this is huge. Balance sheet. What is balance sheet? It's your company health, what you owe and what you own. If you go down here to payroll liabilities, if there's big numbers in here, that's usually a problem. And how do you measure big? If there's numbers in here that seem to be more than like one payroll's worth, you probably have problems. If these numbers are negative, you definitely have problems. In fact, if you see any numbers that are negative at all on this balance sheet, except for numbers over here in owner's equity, and except for, by the way, this is just a demo account. You should also never have any balance in opening balance equity, but especially negative numbers. So any negative numbers except for depreciation, but accumulated depreciation, or down here in equity, you shouldn't have negative numbers here. If you have negative numbers, except for those two places, open the conversation with your accounting team. Hey, this is wrong. Let's fix it. A lot of times that does not work in your favor when the numbers are wrong. Okay. One other thing to look for. All right, if you're doing completed contract method accounting, which means you don't recognize everything until the job's closed, come in here, click customize, go into filter, go into customer, and pick some closed customers or all closed customers, better yet. If the job's closed and you select and you filter it that way and you see numbers in here in assets, so in cash, you'll see numbers. But if you see numbers in here under like assets, like work in progress assets, or if you see numbers down here, customer deposits, you got problems. Okay. Talk to your team, get it fixed.
This might be semi-related. Does a question from the group, does my project manager's salary go into COGS or COGS or fixed cost?
Yeah, great question. It depends. It depends. The most important thing there is consistency. The National Association of Home Builders will give you some guides on how to do that. So project manager salary could be a direct cost or an indirect cost. The best thing to do is to track their time per job. That's hard to do for project managers, but if you can track their time per job, and then you can allocate that above the line, that's ideal, right? If you're looking at benchmark data from the NAHB, that cost is included in cost of sales. So think about this as a litmus test. Project management has to happen. You don't need to actually have staff. You can outsource it. If you're outsourcing the staff, and let's say you have one job, their only job is to make sure that project is working the way it should. That's more clearly and obviously a direct cost for you. So again, the most important, the IRS doesn't care where you put it. Take that with a grain of salt, they sort of do. But the most important thing for you is consistency, because you're going to create a plan, you're going to measure against the plan, just be really consistent. If you have the resources to be able to get the nuances down and track that time and get it put in the right spot, which isn't super easy to do. There's a lot of gymnastics you have to do to get that right. Put it in COGS.
Okay.
Awesome question.
Okay.
Awesome question. Most people don't, by the way. Most people don't, because it's too hard to do administratively. They keep it below the line.
Just to even have insight to like what your project manager is spending per job, you know, or spending, but like spending time at per job could be just huge insight to like, you know, how you are paying out and everything. Yep. So your last point on here was review your P&L by month, any odd trends.
All right. This is something people are probably more familiar with, but they're probably still not doing. Pull up your profit and loss. Let's just look at like last year. And under this display columns by, flip this over to months. And I'm just going to collapse this to make it easier to see for everybody. I'll try to zoom in. Again, this is a demo account, so things are going to look really strange, but advertising, right? If this is 100, 100, 100, 100, 5,000, 100, 100, 100, ask questions. Why is that way? Maybe you know what it is, right? I took out a big ad. I spent a bunch of money on Facebook, whatever it is. Fuel. This is a great example. Fuel. Let's say you're pretty consistent with your jobs and you have, fuel, 100, 100, 100, 2,000. All right. Kate's using the company fuel card again for her personal vacations. So
I love road trips. Yeah.
There's a lot of things you can look at in here, but do this, right? This will help you identify trends. Oh, things are increasing. All right, we maybe need to do something about that. And especially if you measure this against your plan, you can identify when things are getting out of control and you can make an adjustment. So just a couple other things. You're going to be provided with this annual planning template. It's sort of a general template to help you get started with planning. And it's a super easy way to start getting an understanding about what the next year might look like. So there'll be a link in an email where you can get access to this. We were going to cover this, but we're a little bit out of time. We're just going to leave the rest of the time for questions. If we look back at the PowerPoint, here's a couple other things that you should do for 2025 to weaponize your accounting. Create a forecast, use Buildertrend to its fullest extent, use your brains and your guts to make changes, hard to do. And then go to controller.ai and join the wait list, because all of this financial planning stuff isn't really part of Buildertrend, and we're building something that will help you do it really quickly, really easily to stay on top of your plan and how your actuals are tracking to the plan. Let's get into some questions.
Yep. And again, if you guys, so far I don't have any other questions in the QA besides that one about the project manager, but if you do, let me see here. There might be some coming in on the chat. 1 second. So for those of us using construction completed method, should we use cash or accrual in your opinion?
Never use cash accounting for anything.
And why
It's
is
not
that?
in my opinion. It's the way it has to be done. It's not an opinion. It's just factual. Don't use, you can forecast cash. You can manipulate the reporting to understand cash. You can look at the cash reports. But if you're doing cash accounting for your construction business, there's no way to get an accurate reflection of what's actually happening. Go back to that example where I said you took in 100 grand from a client, but you haven't done anything yet. If you're using cash accounting, you have 100 grand in income. Well, let's say that job is a 10% gross profit job. Your true income is 10 grand. And by the way, you haven't earned a dime of that yet. So your true income is 0 until you've earned it. That's the problem with cash accounting for construction. For other businesses, it's not a big deal, right? Because you're turning and burning things. Your projects are short. They're one day, right? You don't have projects. For construction, it's a big deal for 2 reasons. 1, your projects are long-term. And 2, you get the cash first, almost always. You get the money first and then you spend it. Cash accounting, really bad for tax, really bad for tax. And also really bad for analytics. You can't know what's actually happening in your business. So for those of you who look at your P&L and it doesn't make any sense, a lot of the reason for that, there's a lot of reasons it could be. One of it is because you're doing cash accounting. It doesn't tell you anything. It tells you about cash. Who cares? Cash and income are just sort of tangentially related.
I would say you kind of touched on this at the beginning, but just to kind of round us out, what really is the importance of working with an accountant that does understand the industry versus just an accountant that's doing, everyday kind of things, and kind of where your services kind of blend over into that?
Yeah, first, a quick analogy. I was just skiing with my buddies, and nobody got hurt, luckily. But if somebody did, let's say they broke their leg or tore their knee in half, would you go see your cardiologist for that? Or worse, your general practice doctor? No, you'd go to a specialist, somebody who works on knees, who understands knees, because that's where their education is. People don't realize that accountants are very niche. I just had a prospect, a sales call yesterday. She's a CPA. She's been a CPA for 20 years. She has a home building company. She's looking to us to help her. She says she knows nothing about construction accounting. So the importance is, if you look back at all of the things we just talked about, understanding your numbers, benchmarking the numbers, creating a plan, and driving against the plan. If you have a generalist who isn't really versed in those things, 1, your numbers aren't going to be right. Worse, you don't even have an accountant, right? Somebody who's not an accountant, which is what most people are who are doing your books. They don't even know the general principles of accounting, so there's no chance. But then when you evolve a little more and you want it to be construction specific, the challenging parts about that are the revenue recognition, the work in progress adjustments, the completed contract adjustments, knowing how to hold your title company accountable when you get a settlement statement, because those are wrong a lot, right? So all of these little nuances, construction accountant is going to be a little more expensive if you have a real one, but look at all the things we talked about where you save your money over and over and over. So you're not going to go get your knee fixed by your family practice doc, and you shouldn't get your books done by your family practice doc either.
Love that. No, and it's just kind of crazy because, when people go into business, there's things that we're learning every single day. And so that's something that I think people are maybe not always aware of, is just that how specific and how much different, industry, contracting and construction accounting is compared to just everyday accounting. So I think that is a huge point. And I loved what you shared just kind of about, like taxes. It's not all about taxes, but there's a way to set up a plan for financially for your business. So then taxes are better. It's a really more of a holistic approach to our financials instead of just kind of this crash course at the end of, at the beginning of every year where we have to do our taxes. So I really appreciate everything you shared. And I know we're at time and I know people are, have to get back to sites or whatever they're doing today. I do want to just mention that we do have Chris joining us for several of our Buildertrend University events in February, March, and April. So I do want to just highlight, if you are coming to that or you're interested in coming to Buildertrend University, it's coming to Omaha headquarters. We dive into product, we dive into the functionality of the program so you can become a super user or better at your financials. And Chris is actually going to be there. So you're going to actually be able to talk a little bit more one-on-one or in a group setting with him. And we'd love for you guys just to continue the conversation with us. So we will be sending out more information in an email. There is a survey at the end of this session. Please fill out, give us your feedback, give us any insight to what you would like to see in the future. And ultimately, we would love to keep this conversation open. Any final words, Chris?
No, thank you for joining. I love this content. I love home building. I love Buildertrend. And come see me at BTU and come see my team. Peter Olenichek will be there in March. I'll be there in February and April. If you have questions about integration, you have technical questions about the nuances of QuickBooks and connecting it to Buildertrend on Buildertrend, nobody on planet Earth that's more versed in that than Peter Olenichek. Literally the best. And we have other people on our team who are just as good.
Awesome.
Come
Well,
see us.
looking forward to it. Thank you so much. Everyone, I hope you have a great rest of your day. Stay warm if you're in cold places. Bye.
Stay warm, Lauren, up there.
Yeah.